Many floating rate mortgages are tied to LIBOR. So LIBOR plus 1%, LIBOR plus 2%. Companies in many cases borrow on the basis of LIBOR. So LIBOR rates are incredibly influential, which is why this is such a big deal. LIBOR is the London Interbank Offer Rate, and that's essentially a measure, or supposed to be a measure of the creditworthiness of the bank. In other words, it's a rate at which a bank can borrow from another bank in over the short term in that industry. So, for example, if a bank was in serious financial distress, other banks would not lend it money except at incredibly high rates of return. So, what the banks are supposed to do is provide estimates of that rate at which they can borrow or lend from other banks to the various financial regulatory authorities around the world. In England, for example, suppose 16 banks submit their estimates of these offer rates. The Bank of England throws out the top 25%, the top 4, and the bottom 4, keeps the middle 8, takes the average, and publicizes that number. And that number is incredibly influential. As long as you have repeated transactions with the same group of people, the regulatory authorities will probably tend to believe that they know what is going on and they can put a stop to any kind of odd behavior on part of the banks. There are two types of episodes which you need to talk about, right? One group of episodes was before 2008. And what happened there was actually interesting because in many cases, the bank itself had two departments. One was a trading department and the other was a lending department. So if you want to make a profit, what you would like to do is set the rates at points in time when it's beneficial for your trading activity. That's definitely bad. But what happened after 2008 was essentially a case of public confidence. So what banks were saying was, if we quote too high a number, that means no one's willing to lend to us, it's a sign that all the banks are, whichever bank is quoting too high a number, it's a sign that that bank is in financial distress. Well, it may not be. Maybe that's a true estimate, but if you're looking in terms of propping up the public confidence, maybe you want to temporarily report a wrong number. In fact, that's a little bit what Barclays did. Barclays claims that it was trying to keep in the top 4, which means it lowered its numbers, but it kept it in the top 4, knowing that those 4 numbers would be thrown out. So it never actually influenced LIBOR. But it still doesn't address the problem of what happened before 2008 when all the trading divisions across all the banks which were involved in setting LIBOR were busy trying to make money on the basis of choosing an interest rate which is particularly beneficial for them in that point in time. That was just in an effort to make money. It got nothing to do with trying to create public confidence, for example. If you have a group of people dealing with each other and they're all sufficiently sophisticated and they know what they're doing, and regulatory systems work well. The problem happens when you have one group of people who are much less sophisticated than the other group. And in LIBOR's case, if LIBOR affected only the 16 banks or the 20 banks who are involved in it, it wouldn't matter. If they're setting rates, it affects only them. They're all professionals. They can deal with it. The problem is, essentially, once you start dealing with unsophisticated people who really have loans and mortgages and everything tied to LIBOR, but LIBOR is being set completely differently, one of those groups of people are going to be affected. But then the problem becomes particularly worse because it's not that everybody else is worse off. It's one group of unsophisticated people is worse off, but another group is better off. If I'm lending money and LIBOR is too high, I benefit. If I'm borrowing money and LIBOR is too low, I benefit. So in both cases, regulation is probably a good idea when you have different levels of sophistication. If everyone's the same level of sophistication, a self-regulatory mechanism would work pretty well. I would probably say the expertise in trying to understand what are the exact consequences for cash flow, the exact consequences for the amount of risk you're taking. And this, by the way, when I say sophistication, I don't entirely rule out the regulatory authorities, because the regulatory authorities, think of the Bank of England, for example, it hires smart people, doesn't pay them as much as, for example, a top executive in a bank, So in consequence, they don't hire enough regulators who are willing to work on behalf of the public weal. But at the same time, you expect them to monitor people whose whole business, whose whole bonus depends on them trying to get the maximum money possible. So it's a little unbalanced, the fight, I think. It's just make the banks put the money where the mouth is. So on average, for example, suppose you quote a number for LIBOR and you say, I think banks will be willing to lend to me at 2%. And you know that's not true because actually the number is maybe 4% because the bank is a little more distressed than you say it is. Say, fine. If that's the rate which you think banks are willing to lend to you, give me that money at 2%. So if the bank has actually has that, it's fine. But if it is actually 4% is the right number, it's going to be losing money. The same thing in the other way around. So essentially what you're doing is, if banks pick 2 banks or 3 banks at random and let them make them execute on, say, £1 million or £10 million. Right? If it hurts, they will learn very rapidly not to quote fake numbers. But the numbers have to be substantial. I mean, you can't say, okay, lend us £100,000 at 2%. I mean, it's really not much for any bank. £2 million, period of 10 days. If they're quoting too high a number, it's definitely going to hurt them.